My name is Daniel Portelli and I'm an Assistant Manager at BDO Sydney. I work in a team of 6 and we assist small to medium-sized companies and also family groups with their tax and accounting matters. We also get involved with their business decisions and help them achieve their goals. I completed a Bachelor Business degree majoring in accounting at the University of Western Sydney. From there I became a Chartered Accountant in 2007. At BDO you get to work with your clients much more closely and develop a stronger relationship where you may not get that opportunity elsewhere. As a Chartered Accountant, I get to work with the best people in the business. Financial ratios are simple formulas. We use them to compare key financial information of one business to that of another business, other industries, or even itself over a period of time. These ratios are a quick way of detecting problems with a business without having to review very detailed information. Ratios can be helpful to many interested parties such as business leaders, investors and banks to help make decisions. It's like comparing the test scores of one school student with the class average. Ratios generally look at 3 financial areas: profitability, liquidity, solvency. Profitability ratios show how well a company converts sales into profits. The higher the ratio, the better the business. 2 common profitability ratios are net profit and gross profit. Net profit equals sales divided by expenses. Gross profit equals sales divided by the cost of those sales. Gross profit is a measure of business success. The higher the gross profit, the better. The tax office may use these ratios to compare a business to the industry average. If the business performs outside of these averages, then they may investigate further for potential tax fraud. Liquidity ratios measure the ability of a business to convert its short-term assets like clothing stock into cash. In business, cash is king. If a business has no cash, it will eventually fail. 2 common liquidity ratios are current ratio and working capital. Current ratio equals current assets divided by current liabilities. Current ratio measures liquidity, that is, how quickly you can convert assets to cash. Working capital equals current assets minus current liabilities. Working capital is used to measure a business's ability to meet its short-term obligations with its current assets. The larger the working capital, the better able the business is to pay its debts. Liquidity ratios are commonly used by banks to determine if a business can get a short-term finance loan. Solvency ratios measure the ability of a business to meet its long-term debt obligations. If a business measures poorly here, it will find it difficult to attract new investors. The most common solvency ratio is debt to equity. This indicates how much of a business's assets are financed with debt and their ability to pay that debt. Debt to equity equals total liabilities divided by total assets. Investors will use solvency ratios to determine the risk and security of any potential investments. Financial ratios can be applied to any business. Having a good understanding of them allows me to work in any business anywhere in the world.